It's time for the big interview on the April 22nd edition of Money Life. And I am joined right now by Derek Izuel. He is Chief Investment Officer at Shelton Capital Management, where he is also an international portfolio manager. He helps to run the Shelton International Select Equity Fund and the Shelton Emerging Markets Fund. And if you want to learn more about the firm, the funds, and Derek, you're going to go to sheltoncap.com, just like it sounds. Derek Izuel, thanks so much for joining me on Money Life.
My pleasure, Chuck, and thank you for having me on the show.
Derek is here on the Gainbridge Hotline. Gainbridge believes that deferred fixed annuities are a steady, guaranteed way to grow savings. Its innovative self-managed digital platform provides direct access to trusted annuity products without complexity or hidden fees. Learn more at Gainbridge.life. Derek, we're living under the curse of, may you live in interesting times. Certainly, from a market perspective, well, if you said rising interest rates, okay, that's interesting. Higher inflation, that's interesting. War, internationally, that's interesting. Interesting right now is a synonym for terrifying, because as an investor, we're all a little bit frightened by what's going on. How much is this, maybe not business as usual, but the kind of thing that investors expect it, don't be doing it? Or how much of this is we are watching markets change, and we will be discussing the fallout of what's happening now for the next decade?
Well, that is the big question, Chuck, and I think you really made a great point here that a lot of the fundamentals of investing that we have become so used to for the last couple of decades, we may be witnessing a fundamental change in our investing regime right now as we speak, and for exactly the reasons that you described. We're seeing inflation that we haven't seen at levels we haven't seen since in decades, 80s and 70s and such. And as a result, interest rates are following that inflation in order to combat that. And then on top of that, you see a war in Eastern Europe, and you see a reversal in the globalization of our economies, which has been just going one direction for the last several decades as well. And so with all this going on, the investment environment may change considerably.
Let's talk about that reversal of globalization. You are an international equities manager. If we are changing the way globalization works, are we changing the way we should view how we invest internationally? And do you have to change the way you build a portfolio?
Well, we'll still build portfolios the same sort of way. I think that the biggest impact of the reversal of globalization is what we're seeing now. It is one of the contributing factors to higher inflation. And globalization has been one of the driving forces behind deflationary forces over the last, again, we're talking decades, of course. The basic premise was, we're going to build something, you design it here in the U.S. or somewhere in Western Europe, and you send it to Asia or China in order for it to be built, and it's done at a much lower rate, at much lower cost, and those savings are passed on to Western consumers. Well, we've seen now in the last couple of years that that is not politically as popular as it used to be in the West, and so forces are changing such that that activity of globalization is starting to turn. So the important thing from an investor's perspective is that one of the effects of this may be that actually international equities and international stocks start to become somewhat more attractive than they were in the past. And that may sound a little counterintuitive, but
heck yes.
But if you think of it, is that the U.S. stocks, in particular big U.S. growth stocks, were the primary beneficiaries of this globalization. If that globalization now turns around and reverses, well, those stocks are going to have to give back some of the benefits that they got for all these years, and the natural beneficiaries then are going to be the overseas stocks that on a relative basis have suffered some of the consequences.
At the same time, as much as domestically everybody's focused on what's happening here, I mean, American investors are kind of terrible at focusing on the international picture. The truth is, we're so caught up in what's happening here with central bankers and what's happening here with inflation. And whether or not we're going to get involved in war, et cetera, that we're not really watching so much what's been happening in Europe and the rest of the world. And, oh, by the way, all of those places are more impacted, or it seems, than we have been so far. So if we're going to see this opportunity for international down the line, how far down the line is it? I mean, as you said, counterintuitive. Oh, yes, counterintuitive, especially if we're trying to see it now. Well, they've got much more pressure from the war happening.
Yeah, that's true. And the timing is difficult. And there are certainly considerable sources of volatility in place from the Russia-Ukraine conflict that in the short term, and let's hope it's just in the short term, it could be longer, are going to make the decision of, maybe if you're thinking about overweighting international stocks, if the decision of when to get in more difficult. But having said that, overseas stocks are cheaper relative to U.S. stocks than they have been almost any time in history. They've always been cheaper. The U.S. has always been more expensive, but that spread, that margin, that premium that you pay for U.S. stocks is as high as it's ever been. So sometimes, the age-old saying, crisis or volatility is an opportunity. I think to some extent you're getting paid to take that risk. And so if you've got the stomach for it, in the medium to longer term, it is likely to pay off.
Let's talk a little bit about emerging markets. Russia, of course, would have fallen into that category. Now it's off of everybody's investment list. How does that change allocations? Does it make you want to look more towards frontier markets to diversify? Does it make you want to try to figure things out when BRIC is missing a letter and it's BIC? It just sounds like an old disposable pen. It doesn't sound like something solid.
Emerging markets have a couple of things going in their favor. Obviously, you're right. One of the letters in BRIC is missing, the R. And you know what? The C has been in trouble for about almost 2 years now. So even though the Chinese markets have been down considerably since the summer of 2020, and that's a big piece of emerging markets. So it's certainly, probably 2 to 3 times as much as Russia is. China is that much larger within the emerging market space. So I think that's one of the things, that China has been beat up a lot. And what's been going on? Well, fundamentally, China has been showing the dark side of this authoritarian capitalist system that they've had. I can remember articles some 2 to 3 years ago about, well, maybe this central controlled capitalism works better than the typical, more laissez-faire capitalism of the West. Yeah, I guess the last couple of years have shown that maybe that's not the case, that the central government in China was starting to feel like they were losing the control that they'd like over the country, and were taking steps to get the country and their economy back into their grip. So we saw them, they put into regulations into their credit markets that have turned the real estate market upside down there. They took active steps to restrict their technology and growth companies in many different ways. And those stocks have given up tremendous amounts of their value. We all know their names: Alibaba, Tencent, et cetera. The thing is that, and also, let's just not even get into the details of how they've handled the COVID crisis, but now, so China's down, based on these things. You're starting to see some signs that there might be a bottom for China. And these real estate credit markets are starting to finding a base. And China's central government has started to change their tune. They've sort of seen some of the damage that their activity has done. Obviously, we'll see if actions match words. But if you can find, and we try and focus on Chinese stocks that are going to help liberalize, for lack of a better term, the Chinese economy, as opposed to those that are going to help the government, because we want to see China's government become less authoritarian and more accommodative to the economy. And so in that case, I think there's some opportunity there. The second thing I would say also is that we've seen this commodity cycle begin now, and certainly the Russia-Ukraine war has only exacerbated that. And emerging markets are generally a beneficiary of that. A lot of them are sources of these commodities. And so if we get into a stronger commodity cycle here, they stand to benefit. And those are countries, Brazil, Indonesia, not India so much, but a lot of the Latin American countries, and many other parts of the emerging world where a larger portion of their economies are based on commodities.
It's interesting to me that, of course, we're seeing these opportunities, at a time when the world has so much turmoil that, if there was a positive to war in Ukraine, the positive was, well, at least we now got COVID off of the front page and out of the headlines. And as much as, it's true, I kind of hate that joke because COVID is no joke and it's still out there. How much do you worry that could be a problem? I mean, we're talking China a little bit here. China certainly has COVID issues and is going to have them for a while yet, maybe more based on how they're handling it than what's actually happening. But how much do you worry that we're not done and that COVID could come back?
Well, I think it is still certainly an issue in China. The thing that gives me confidence, even with regards to China when it comes to COVID, is even for all of these different waves of COVID, and at the risk of trying to sound like a medical expert that I'm not, but at least looking at it from a financial perspective, that the markets have had a pretty good, when we have these waves of COVID, every one of them seems to be shorter and less severe. And they've always, regardless sort of what measures are taken to combat them, they tend to kind of go away on their own. And I think we'll even see that in China. I mean, China's locking down Shanghai and many other cities. Regardless of that, I think at some point this wave that's going through China will subside regardless. And so in that perspective, I'm not as worried about it. And I do think that the financial markets have done a pretty good job of assessing the risks of these different waves and reflected that in the underlying security prices.
Derek, I have more questions. Unfortunately, I don't have more time, but this has been great. I very much appreciate you taking the time out to join me, and I hope we'll get a chance to chat again down the line.
I hope so too, Chuck. Thanks again for having me on.
That's Derek Izuel. He's the Chief Investment Officer and International Portfolio Manager for Shelton Capital Management. SheltonCap.com is their website. Shelton International Select Equity, SISLX, and Shelton Emerging Markets, EMSLX, for more information. We'll be back to wrap up today's show, let you know what's coming next week when we start our 10th anniversary celebration. That's coming up, and we got a contest winner to announce right after this message.